Hi, I'm Tom Mihawk, and this is Bonds Basics. This is part of a series of shortened videos about investments, stocks, mutual funds, alternatives, bonds, retirement, and housing. And they're designed to be faster, where my investment fundamentals original video was three videos. This one I just did was one, and it's maybe 14 minutes, fast, easy to watch. I'm going to include with Bonds Basics, as I have done with the others, as I'm going to try to, the slides. So you can look at the slides, take notes, print them, whatever you want to do. And I'll put those in the notes in the YouTube video when you watch it. So what is a bond? A bond is a debt or fixed. It's a debt by the issuer. It's an investment of the person buying the bond, or a fixed income offering that pays interest as a percentage in what we call the coupon rate of the amount, which is principal, that they lent. It's the amount that you invest. That coupon rate percentage is the coupon you receive. There's a guarantee of the return of principal. Now, there are risks of payment of interest, repayment of the principal, and a reduction in value over time. Excuse me, in time due to changing interest rates and inflation. So returns, the coupon payments are guaranteed, but there's some risk. You can measure your risk by the rating of the bond, by the company it's issued it, by when you buy it in the economy, all these kinds of things. But in general, its merit is that its returns are guaranteed. Why invest in bonds? Well, there is a required repayment. Compared to stocks, there's no required repayment. Stocks have the lowest, you're the lowest person in terms of, you're the last claim on rights at the company. Bonds have a much higher claim. Now, you should and do get a lower rate of return than you do for stocks, but it's required. You get regular income. You may be offered some growth potential depending on when you buy. If you buy a bond at issue and you hold it until maturity, you're going to get the coupon rate of return as your internal rate of return. But if you buy it at issue and sell it before maturity and interest rates go down and prices go up, well, you'll have made more than the coupon rate of return. It's safe. It's safe. It's because of the guaranteed return element. It's much safer. And it's an important diversifying security for portfolios, lowering risk and lowering volatility. It's kind of like in a car, the shock absorber, right? Cars have springs, and if cars only had springs, car would be bouncing up and down the road, boing, 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 right? The shock absorber causes the spring to, it attenuates the spring so that it returns to normal. So it goes boing, boing, like this. And bonds perform a similar type of function in a portfolio. They provide a guaranteed rate of return. It's lower than stocks, but for the short term, it's a great thing to own. You're getting married in a year, having kids in soon, starting a business, maybe a bond return, a safe bond return is useful to have. Bonds come in debentures, which are unsecured, meaning no collateral. It's just issued. Your way of determining what the bond's risk is by its rating, the company issuing it, reading the prospectus, that sort of thing. Mortgage bonds have collateral. Now, we haven't really talked about this yet, but collateral is a claim on an asset of the issuer such that if the issuer doesn't make payment, the bondholders can take that asset. A simple corollary would be for most people's homes, right? The home is collateral for the loan. And so if you don't make your payments, the bank takes your home. They don't want to own your home. They want you to pay back the loan. But they own the home if you don't make the payments. By the way, if it weren't for the collateral, mortgage loans would be much higher. And same with bonds. The prices would be much higher because of the greater risk. So with the presence of collateral, mortgages are more affordable by more people because coupon rates are able to be lower. Same for bonds. When there's collateral, the rates are lower. Subordinated means that its claim comes behind another bond, meaning if the company ends up in critical condition, the first claim gets paid first, the second, or the subordinated bonds get paid second. Who gets paid more? The subordinated bonds, because they have a riskier claim. Convertible bonds mean they can be converted to stock. It gives the company the ability to take away the bond, take away the payment at a certain pre-agreed price and convert it to their stock. The investor in the bonds has the ability to earn a greater return because stocks earn generally greater returns over time than do bonds. High yield bonds, less than triple B rated, they're less than a certain level, this triple B I mentioned, not considered investment grade. Because they're riskier, they pay more in return. Governments issue bonds, federal agencies, corporations of all kinds like Apple and Microsoft and Google, municipalities like local governments do. The important bond details, the face value. You buy it at $1,000 face value. It doesn't mean that, if you want to buy $5,000 worth, you buy 5 of them, right? So it's a kind of a nominal measure. The coupon rate is the percentage of the par value paid in terms of interest. Maturity, how long will the bond, when will the bond pay you back? So you invest today, in 10 years, you get your money back, and interest all the intervening years. That's a 10-year maturity. 20 years, 20-year maturity. The bond may be bought at issue, may be bought in the market later, sold before maturity or at maturity. You have almost complete complete flexibility to buy and sell when you want. Bonds are so cool because the yield to maturity is an estimate of the rate of return the bondholder gets if they hold until maturity. Here's what happens. If I issue a bond today at 100 and I pay a 10% coupon, and next year interest rates, and I do that with the advice of my investment bankers, and it's based on the market, based on my credit quality and the risk of my company. Next year interest rates go up. Same bonds, same risk, same kind of company. Next year they pay 15%. Well, what happens to my current bonds that are paying 10? Price goes down. Price goes down. Now people buy the bond at, instead of 100, maybe they buy it at $75, right? To get a 10% coupon. And what happens is this yield to maturity tracks the amount of time left until maturity and the rate of return, and includes the fact that you bought it at a discount. So the yield to maturity is going to roughly reflect the market. It's going to roughly be around 15, which is what current issuing bonds are doing. It's an amazing relationship, this yield to maturity measure. Market prices for bonds vary as interest rates change. When interest rates increase, new similar bonds issue at higher rates, making the old bonds less valuable, like I just said. The old, less valuable bond may now be purchased at lower prices than par. In combination with the coupon payment, it makes the yield to maturity greater than the coupon rate. My example was I issued a 10% coupon, yield to maturity is around 15. When interest rates decline, the old bond is worth more due to the higher coupon rate. So if interest rates in the next year went down to 5, my 10% bond will be worth more. People would have to pay $125 for my $100 bond. All right? The upshot is that when interest rates go down, bond prices go up, and when interest rates go up, bond prices go down. They move in opposite directions. Government bonds come in bills, notes, bonds. Bills are short-term, notes are medium-term, bonds are long-term. These are like U.S. Treasury government bonds. Treasury inflation-protected securities, or TIPS, come in 5, 10, and 30-year terms. They move based on the consumer price index, their value, and they mitigate the effects of inflation. I just talked about where when inflation goes up, bond price goes down, inflation goes down, bond price goes up. TIPS mitigate that risk that you buy a bond, interest rates go up, and your value goes down. Okay? Remember, if you buy at issue and you sell at maturity, you will get as a rate of return the coupon rate. It's only when you buy at an issue and sell sooner than maturity, or buy between issue and maturity and then sell later. That's when you're most risk, when you're kind of more of a trader. Now, this is something you should be aware of. This is the Treasury yield curve. This is for U.S. governments, but other corporates could be graphed too. And what this shows is bonds with 1, 3 month maturities, 1 year, 3 years, 5 years, for example, at different times. Currently, which was March of 2020, March of 2019, March of 2018. Generally speaking, a yield curve looks like this. It's positively sloped. When it's flat, as in March of 2019, it generally indicates soon in the future, don't know how soon, but in the future, there'll be a recession when there's a flat yield curve. A positively sloped yield curve is generally indicative of a healthy economy. The longer you borrow, 30 years, the more you have to pay people because it's riskier. Bonds are rated AAA, AA, single A. There are 3 companies, Moody's, Standard & Poor's, and Fitch. They have different ratings names. They're not all AAA. One might be large A, 2 little a, or something like that. But in general, they mean the same thing. Very best, really good, good, and that sort of thing. Triple B and below are considered non-investment grade. Triple B and above are considered investment grade. Below that are non-investment grade. And so you can see default rates here on the right in this chart where AAA has no examples of default. Triple B investment grade has 3% example of default, and triple C 43%. Now notice they pay 9.9% average coupon. Pretty good, but high default rate, very risky in terms of not being able to keep them through maturity. Duration is an important measure of the bond's movement relative to changes in interest rates. For a bond when there's a 1% change in interest rates, a bond with a duration of 7 years, its price will change 7%. So longer bonds with longer durations have greater price change than shorter bonds with shorter durations. Duration measures the sensitivity of a bond sensitivity of a bond's price to a change in interest rates. It tells how long in years for an investor to be repaid the bond's purchase price in the total remaining cash flows, meaning coupons and return of principal, and how much its price will change for a change in interest rates. The longer the bond's maturity, the longer its duration, and the greater its price movement when interest rates change. If you're concerned about interest rates going up, meaning bond prices will go down, own a shorter bond. Whoops, let's go over here. Own a shorter bond, 1 year, 3 years, 3 months, 6 months. So if interest rates do go up, its price won't go down very much. Duration is an important measure. So why invest in bonds in summary? Regular income compared to stocks. It's required that you be repaid. Okay, if investors don't get repaid, they sue to be repaid. It may offer growth potential depending on when you buy the bond and when you sell it. Safety, remember the car example, car with no shock absorbers and only springs goes boing, 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 boing as it goes down the road. Where a car with a shock absorber goes boing, boing. And bonds have that kind of effect in a portfolio, provides return, mitigates positively the impact of volatility in a portfolio. It's an important diversifying security in portfolios.